Welcome back to our channel, where we talk about all things ETFs. In this video, we are going to discuss the iShares Russell Midcap Value ETF, IWS, which is one of the most popular mid-cap value ETFs in the market. If you're not familiar with ETFs, let me give you a quick definition. An ETF, or exchange-traded fund, is a type of investment fund that pools together investors' money and invests it in a diverse portfolio of stocks, bonds, or other assets. IWS, specifically, is an ETF that invests in mid-sized companies that are deemed undervalued by the market. Let's dive deeper into what IWS is all about. IWS is designed to track the performance of the Russell Midcap Value Index, which is a subset of the broader Russell Midcap Index. The Russell Midcap Index is made up of 800 mid-sized companies, and the Russell Midcap Value Index is made up of the 350 mid-sized companies that are classified as value stocks. Now, you might be wondering, what is a value stock? Well, a value stock is one that is considered to be undervalued by the market. These companies typically have lower than average price-to-earnings ratios, price-to-book ratios, or other valuation metrics. The idea behind IWS is that it offers investors exposure to these undervalued mid-cap companies, which have the potential to outperform the broader market in the long run. IWS does this by investing in a diversified portfolio of mid-cap value stocks. One of the key benefits of investing in IWS is diversification. Since IWS invests in a diversified portfolio of mid-cap value stocks, it offers investors exposure to a broad range of companies across various sectors. This helps to spread out risk, which is important in any investment strategy. Another benefit of investing in IWS is the potential for outperformance. Historically, mid-cap value stocks have outperformed both large-cap and small-cap stocks over the long term. This is because mid-cap value stocks are often overlooked by the market and can provide greater growth potential than larger, more established companies. Additionally, IWS has a relatively low expense ratio of just 0.24%. This is lower than the average expense ratio for ETFs, which is around 0.44%. A lower expense ratio means more of your money goes towards investing and less towards fees. As with any investment, there are risks associated with investing in IWS. One potential risk is the concentration of holdings. Since IWS tracks the Russell Midcap Value Index, its holdings are limited to the 350 companies in that index. This means that if one of those companies performs poorly, it can have a significant impact on the overall performance of IWS. Another risk is the potential for volatility. Mid-cap companies can be more volatile than larger, more established companies, which can lead to greater price swings in the short term. It's also worth noting that IWS has a bias towards certain sectors, such as financials and industrials. This means that if those sectors perform poorly, it can have a negative impact on the overall performance of IWS. IWS is best suited for investors who are looking for exposure to mid-cap value stocks and who are comfortable with the risks associated with this type of investment. It's also a good option for investors who are looking to diversify their portfolio or who are looking for a lower-cost alternative to actively managed funds.